morning. Today is January 23rd, 2025, and welcome to the New Possibilities Hour, part of the Will Work for Food project founded by Natalie Armstrong-Motan. Every week, Jean Lawler and I are delighted to host another cutting-edge webinar for lawyers, mediators, arbitrators, and everybody who negotiates. As you know, there's no charge for these great programs. Rather, we ask you to contribute to a food bank if you like what you see. And I must say, our generous audiences have been wonderfully generous in contributing to food banks in honor of our great speakers. One of my favorite parts of the webinar each week is when we announce the running total of just how much our audiences have contributed since we began the series almost 5 years ago. Natalie Armstrong-Motan, would you please do the honors?
Hey, Jeff, thanks. It's absolutely my honor to take Jean's role in the Will Work for Food presentations. We have, to date, been told about $680,173.63 in donations to food banks around the world. Thank you all so much for your generosity.
Fabulous, fabulous. Thank you all. Today we have I must say, a regrettably timely presentation. As you know, the Los Angeles area has been devastated by wildfires over the past several weeks. And the issues relating to pursuing, litigating, and settling claims related to natural disasters is sadly on everyone's mind. And it is something to which we must attend. And today we have a wonderful guest, an expert in the area who will educate us on these sensitive and important subjects. It's Shant Karnikian. Shant is the managing partner of Kabateck LLP here in Los Angeles. Kabateck LLP is one of our region's leading firms in the representation of consumers, people who have been injured either physically, financially, or in other ways. Kabateck LLP is one of the leading firms seeking redress on behalf of such individuals and companies. Shant, please tell us a little bit about the food bank to which you would like people to contribute if they're in a position to do so. And then on with this very important presentation. The floor is yours.
Thank you, Jeff. Thank you, Natalie. And what a great cause this is. And I'm sort of embarrassed to say I hadn't heard about this. And this is really awesome. I certainly will keep tuning into these because looking at the future schedule, there's a lot of relevant stuff, just either interesting or relevant to some of the areas I practice in. The food bank I've suggested for today is the St. Francis Center. It's in downtown Los Angeles. They make an effort to feed the homeless or those that are very low income that need it. It came to mind because I used to volunteer there through Loyola Law School. We would put on every Saturday or once a month, Saturday at 7 a.m. We'd go in and we'd help serve food to the homeless. And what I thought was special about it wasn't just handing out food, which is already noble enough and a great way to do this, but they in fact kind of treat it as a restaurant where everyone gets seated and orders are taken and they're served food. So it's a very, I thought, very dignified way, and the demographic that it serves found it very dignified and very special to be able to go in on a Saturday morning and get a meal in a almost restaurant type setting where there's someone serving and talking to them. And that's what they do. They have a food pantry, but they also do these meals for those in need. And I thought it was really special how they did that. And, you know, close to my heart, I'm a Loyola alum, I'm on the Loyola board, and it's a cause that we try to support through that board. So thank you, Jeff, for creating the opportunity. It's awesome.
You're welcome.
All right. And your next instruction was to take it away. So let me make sure I can share this the right way. Okay. Hopefully you guys are seeing the actual PowerPoint and not the presenter panel for it. But Natalie, is that right? Are we good?
It looks
We
gorgeous.
are good.
Okay. All right. So this is actually something I've lectured on before and done even CLE sessions on them, hour and a half, 2 hour long CLE sessions on it, because it's sort of been part of my practice, responding to natural disasters and working out the different paths to recovery, whether it be insurance claims or going after responsible parties, and all the little intricacies that come up. It's sort of like the almost perfect cross section of what Brian Kabateck, my mentor and the firm's founding partner, had worked on in the wake of the Northridge earthquake and other disasters and hurricanes throughout the country, and also what I ended up practicing, doing property damage, construction defect type of cases, insurance bad faith, whether it's first party or third party. So it's always been something that's close to my heart, and it saddens me to see that this has become like a new hot or very relevant area. As Jeff said, it's unfortunately timely to talk about this. So a couple of disclaimers. This is more geared towards the general public and not so much lawyers, but obviously this isn't legal advice, especially in the insurance world. A lot of the issues that are dependent on the actual language in the policies, their contracts, they're very, very fact and language specific. This doesn't create an attorney-client relationship. I don't represent anyone here, and I'm sure many of you know that and understand that concept, but just to be clear. And also, this truly isn't an effort for me to solicit business or ask anyone to come to me or say, I'm available to help everyone. In fact, what I genuinely want people to get out of this is, if you have a client base or even friends, or if you've been unfortunately affected, I just want you to have some familiarity so you can speak with some degree of confidence and instill confidence in the people affected by this, because I think having that starting point really helps people, and it gives them a sense of, okay, this is daunting, but at least I have some understanding of what the different paths are and what the rules are that apply. All right, so there's two paths that I like to summarize, and we'll go over each one in greater depth. The first one to be able to recover is through an insurance claim, and that's what people call the first party claim, where you make a claim with your own, where the policyholder makes a claim with their own insurance carrier. Oftentimes, I'm going to speak about a lot of this in the homeowner's policy context. They make a claim with their homeowner's policy, and inevitably, I'm not going to guarantee that everyone's underinsured, but inevitably, underinsurance is a really terrible problem that's going to plague everyone in Southern California at some point. And then the other path, the sort of parallel concurrent path, it's not mutually exclusive, is to pursue, if there is, and for example, again, unfortunately, in the present context, in the Eaton fire context, it looks like there is a possible potential path for seeking remuneration from the at-fault party, which would maybe Southern California Edison. So there's the third party path as well. It's not, they're not mutually exclusive. You don't have to do both. You don't have to pursue both. Even if you have the best insurance coverage in the world and there's a third party at fault, you can pursue them as well. Obviously, the third party claim requires proving that third party's negligent or violation of the law, or whatever the basis for liability is. It requires proving your damages. So I promise that my whole PowerPoint isn't a bunch of just giant statutes, but I did want to talk about one that is very important, California Insurance Code Section 2070. This is the standard form fire policy. And what does that mean? The California Insurance Code, much like many states, and I'll go over a little bit of the history of that, outlines what a fire insurance policy needs to look like. And it says no part of the standard form shall be omitted. But then there's an exception, except when the coverage with respect to the peril of fire, when viewed in its entirety, is substantially equivalent to or more favorable to the insured than contained in the standard fire insurance policy. And what does that mean? Literally, 2071, the next section, has a standard form that if somebody wanted to start an insurance company tomorrow and issue fire policies, they could copy and paste, which contains the minimum of what's covered. What does it boil down to? That the peril of fire, any damage from fire, is covered, and it doesn't set the minimum for a dollar amount. Obviously, that's what the insurer and the insured agree upon the coverage is, but the form of coverage is standardized. And what's the history of this? This is called the New York Standard Fire Policy. This was a law passed by the state of New York in the aftermath of a series of terrible fires in the 19th century. the New York fire, there's a giant fire in Chicago. These were some of the deadliest fires and caused a substantial deal of property damage in those areas. And what happened in the wake of those fires, because there was no uniformity or standard policy, there was a lot of ambiguity, a lot of fights over coverage between insureds and carriers. And a lot of people ended up not having coverage and not being able to rebuild. So it was a huge economic hit for these cities and the people living in these cities and the economies of these cities. So in 1886, New York created a standard form, and that became the first standardized insurance contract in the United States, and many states use it now. And it's literally that, it's the one California has, this one we're looking at, is some evolution of that New York standard fire policy. Okay, so let's talk about how to take a look at a policy. Someone comes to you and says, here's my policy, what are my coverages? Let's start with the declarations page. This is what a lot of people think as their insurance policy, but it's not necessarily the whole policy. This is kind of the summary, and it contains a lot of key points. You'll have the policy number and relevant information here, premiums, description of what is insured, the type of property, often the address. But then the important part that I want to talk about is the coverages, and we'll delve into that. The actual policy is a much longer document. It's not the 2, 3, or 5-page declarations page we looked at. The actual policy can be, this is just a sample, this is a farmer's policy that's over 21 pages long, or actually the bottom right here says 1 of 42. So it's a very long document. It's a contract. Not every policyholder has this in hand, but it's a contract they're a party to, so they should have access to it. The insurance company is obligated to share it with them, but this is what comprises the policy. And why is that important? Because most of you, I assume, are lawyers. It's a contract, and the words in the contract matter, and they are what creates the relationship and the obligations in the relationship. And oftentimes the way it works is the declarations page it'll have those coverages, but then it'll have references to what are called endorsements. It'll say, this section lists endorsements that make up your insurance contract. And I pulled a sample here, it'll have a list of numbers. And then if you have the full copy, attached to the entire policy will be little addendums or endorsements that specify or limit or further define coverage. This one, for example, in this farmer's policy is a smoke, soot, and wildfire smoke, soot, ash, char sublimit of $5,000. Fun fact, this is how the mechanics of it work, but fun fact, these are unenforceable under California law. Why? Because it violates Insurance Code Section 2071. Because if you take out $1 million policy for the peril of fire, it's violating that minimum standard form coverage to say, well, yes, you have $1 million in fire coverage, but if it's smoke from a wildfire, then it's limited to $5,000. And that's something that I actually kind of earlier in my career litigated in class actions against multiple carriers. And we could talk about that a little bit more, but that's to sort of illustrate how it works. And it's very important to kind of look at those endorsements and read the full contract, because you will have exclusions, but then you will have exceptions to those exclusions through an endorsement. So things get added back, and you got to look at it as a whole. And it's kind of tedious to do oftentimes to read the policy, but it's interesting as well. All right, let's talk about those coverages that I mentioned. They're standardized in the way that they refer to them: coverage A, B, C, D, and then a few other standard items that very commonly appear in homeowners policies. Coverage A is for the dwelling. This is the physical structure of the main dwelling house, like the main structure on the property. And it'll be a limit. It's set by the insurance company. And I'll talk a little bit later about underinsurance and how those limits are set and how to deal with that issue that comes up. It includes any attached structures like a attached garage, an attached guest house, fireplace, fixtures that are sort of built into the house. Coverage B is for separate structures. This is a detached garage, a detached patio, gazebo. Sometimes it includes fencing, pools, other structures that aren't part of the main house. And it's usually, this is a rule of thumb, but it's not always consistent. It's usually 10% of the coverage A policy limit. Coverage C is for personal property, contents, belongings. There's other names are used. Most often it's called personal property. That is everything in the house, everything in the property, from chairs to desks to rugs to appliances to washing machines to the food in the house to the clothes in the house. Basically, if you took the house, turned it upside down and shook it, everything that would fall out. And that's often a function of coverage A, but less often than what we saw with coverage B being a percentage of coverage A. Now, coverage D is loss of use, also often referred to as additional living expenses. And this is to compensate the policyholder for any increased cost of living or replacement housing while they are displaced as a result of a covered loss. And this comes in different forms. One of them is you get the fair market rental value of the home, even if you choose to live in your car or live with a relative or have a second home that you're living in and not paying rent towards. That's sort of a little bit rarer, might be under some higher end policies. The most common one is the second I put in this list of different forms, the incurred amount, which I think is probably this policy. Over here it says $226,000 over the course of 24 months. Again, that doesn't mean you get all $226,000 or that you can be out of the house for 24 months. Those are maximums. What they will approve on a monthly basis is replacement housing and the cost of living in that replacement housing comparable to the home that you are now out of or the policyholder is now out of. And there will be a dispute over that very often. They'll say, you can find a 4-bedroom home for $2,000 a month. And then you have to go to them and say, no, I can't even find an apartment for that much, especially in the wake of mass disasters when there's a surge in pricing. And then another form of it is the time limitation type, which is will cover comparable housing and comparable living expenses for a period of 24 months, period. And they don't put a dollar amount on it. But again, of course, there will be some dispute or a negotiation as to what that dollar amount is. Other important coverages or portions of the declarations to be aware of. Extended replacement costs. This is something that increases the coverage A for repairing damage, covered damage to the dwelling. And why is it listed? I always wondered early on, why is this listed separately? Why, over here it looks like 282,000 is 50% of the coverage A coverage, the 565. So why is it listed separately? Well, it's because when they set the limits on coverage A, it's based on what often the insurance company considers to be the current cost of repair, and the extended replacement cost is something you can add on for additional premium that is a fail-safe or some kind of a safety net against market saturation, prices skyrocketing. It's useful in the situation we're seeing now, mass disasters, where the price of everything is going to go up. When you have thousands of structures being rebuilt in the same time span, from labor to the availability of parts to the price of screws, everything's going to go up. So it's helpful for that. Another important type of coverage to look for that's available under some homeowners policies is law and ordinance or code upgrade. There's different terms. Over here it's building ordinance or law. Because the insurance policy, the homeowner's policy, often only allows the homeowner or policyholder to rebuild to the condition that the property was in before. No betterment. Inevitably, there might be some things that get upgraded, but if there's some major upgrade that's necessary, if the law prevents or precludes the home from being rebuilt the way it previously was, given size or certain features in terms of the insulation or wiring or stairs, things like that. And when applying for a permit, especially in the wake of a total loss, and the city says, no, you can't do it like that. The plans have to be totally redrawn. There needs to be major changes. That's often going to cost more. And without law and ordinance coverage or code upgrade coverage, the insurance company can say, no, we'll only pay for what it would cost to rebuild the prior home. We won't pay for those changes. So this adds 10% of the coverage A limit to help with that. So that's something that policyholders often need to take advantage of in the wake of mass disasters. There's other coverages that often come into play and are relevant in mass disasters. Trees, plants, shrubs coverage, things for landscaping. It's, again, often a function of a percentage of the coverage A. It'll be like 5-10%, or just might be a stated amount. Debris removal is also another big one, because if it's total loss, clearing the lot is oftentimes very expensive. But one thing to be aware of is in mass disasters, oftentimes the state and or federal government come in to coordinate debris removal, and they will do it. And what they will seek from the homeowner is an assignment of their debris removal benefits in their insurance policy. So the state or whatever entity did the debris removal can recoup some of it. So if you're talking to someone and that's an option for the state to come in and remove the debris, let them do that and deal with the signing of it afterwards. What I've seen in the wake of, for example, Woolsey fires in Malibu is the county or whoever coordinated the debris removal isn't going to put the amount that you owe them for their debris removal into collections afterwards if you don't reimburse them. So just have them do it, and then if need be and the coverage is available, assign to them the policyholder's rights for debris removal. Sublimits, we talked about this earlier, and for example, here's the $5,000 wildfire smoke sublimit under this policy, which is not enforceable. But there's sublimits that are enforceable, like a mold sublimit. A lot of policies say we won't cover more than $10,000 for mold damage, and those are enforceable because they're not the peril of fire. And something interesting to talk about here, which is coming up as an issue when I talk to people dealing with claims in the wake of these fires here, is wildfire deductibles. So a policy will have, let's say, $1 million in coverage, and their regular deductible is $2,500 or $5,000, which is fine. A deductible is fine. But if the damage is caused by the policy purports to say that if the damage is caused by a wildfire, then the deductible is, I've seen anywhere from $50,000 to $100,000 to $250,000 on some really big policies, which to me is very reminiscent of these smoke and ash sublimits that we challenged. And that's something that I'm looking at and wondering, does that violate 2070 and 2071? Because you have $1 million in coverage for fire damage, but as a result of this wildfire deductible, it really reduces it to something less than the coverage that was negotiated. So that's something that I'm kind of thinking about, and I really want to look into. Other coverages, there may be coverage for special contents, coins, jewelry, collectibles, guns, cash. To have the real benefit of that, some policies have scheduled items where you list out, here's this piece of jewelry, it's worth X amount. So you got to take a look at the policy to see what it says as to that, and the attached endorsements, schedules, things like that. And then business interruption coverage for businesses that may apply to. California Fair Plan, that's come up a lot, and it's sort of a hot topic. It's the insurer of last resort. It's not a state-run entity. It's not a government-backed entity. It's actually funded by money from private insurers, but it's mandated by the state. It provides very limited coverage. It's the insurer of last resort that people get when a standard carrier won't insure the property. It's very limited coverage. It's sometimes for fire only, and the amounts are low. Sometimes carriers, other mainstream carriers, not fair plan carriers, will offer their coverage only as a supplement or add-on on top of a base plan from the fair plan. But even then, it'll be pretty limited. From the ones I've seen now, some of them just, they offer minimal fire coverage, building coverage A that we talked about in those ABCs, but no coverage for loss of use. So, and it's a little tricky to review the coverage under that framework, because you have to, especially if it's one policy added on top of another, you have to compare them and figure out how they stack. And again, another hot topic, and I've spoken about this recently in the media, is, what if the fair plan fails? What's going to happen? Is this going to create an insurance crisis? Well, yes and no. I think the fear about it is being blown out of proportion because these carriers that back the FAIR Plan, that are obligated to replenish the FAIR Plan funds, they also have reinsurance for the risk that they have. They have special reinsurance for mass catastrophes like this. So these are some of the most sophisticated financial institutions in the world. So they wouldn't be taking on this kind of risk without having some type of backstop, which is where the reinsurance kicks in. Yes, will premiums go up? Will more carriers try to pull out? Absolutely. I have no doubt about that. But I don't know if it's, the insurance system is going to collapse. There may be a shift and a lot of discussion about it, but I don't think it's dire or catastrophic in terms of the insurance industry. Another issue that comes up often in in the context of wildfires is public adjusters. Should a policyholder hire a public adjuster? What do they do? And I could give a brief overview of that. Public adjusters are basically claims handlers that work on behalf of the homeowner or policyholder, as opposed to someone hired on behalf of the insurance company or an employee of the insurance company. There's some licensure by the state, and I don't know how stringent it is. I have no ability to comment on that. I don't know if they have to take or pass the equivalent of a bar exam, or they have the equivalent of a code of ethics to follow. But they are licensed and regulated by the state. They evaluate the damage, they prepare estimates. Oftentimes they're good at doing that because that's what they do and they're familiar with the industry. Oftentimes they're former insurance company adjusters, and they present the claim to the insurance company and they negotiate the claim with the insurance company. They coordinate with inspectors and vendors that are going to advocate on behalf of the policyholder. So that's the role that they play. There's pros and cons. They can offer a service instead of a homeowner or policyholder dealing with the somewhat arduous process themselves. It's very useful for complex claims. They work on a contingency, so it incentivizes them to try to maximize the recovery. And another advantage is if they are good and they do a good job of documenting the file, you have a well-documented file, which comes into play later on when you're pursuing, if there is a tortfeasor to pursue, when you're pursuing the tortfeasor and trying to establish your damages there, you'll already have a built-in sort of documentation of all the damages and how much you sought from the insurance company and how much you're still owed on top of what you got from insurance. The downside is there's a financial cost. They charge a percentage of the recovery. And that can be substantial, especially if the claim is a straightforward claim and the insurance company is just going to dump all the policy limits and turn it over anyway. So they may end up getting paid for making a few phone calls and having a few conversations. So that's something to be mindful of. And if you have an inexperienced public adjuster, they can botch the claim. And I've stepped into litigation after a sort of complicated or claim that went south in both scenarios. I've stepped in when there was a great public adjuster and in fact have used those public adjusters as percipient and even sometimes expert witnesses in the subsequent insurance bad faith lawsuit against the carrier. And I've also had situations where the public adjuster totally botched the claim and it's a big mess that we have to clean up and it's harmful to the subsequent insurance bad faith lawsuit against the carrier. Ultimately, I don't have a rule of thumb about yes, hire one, don't hire one. It's a personal choice for the policyholder to make. I don't have a recommendation or a one-size-fits-all rule there. So that takes us to underinsurance. Why is there going to be a major problem with underinsurance? In the wake of a mass disaster, you have a lot of price surges. You have multiple, even though there will be an influx of contractors looking for this type of work, just getting things to a location and getting labor to a location and working in a disaster zone like that is just logistically more difficult. So it drives up the cost. Also, underinsurance, even prior to the event happening, to the disaster or any type of loss happening, is often an issue because the carriers are not incentivized to sell further insurance limits because the rates that they can charge, the premiums they can charge are regulated. And for the first sort of chunk of coverage that they charge, that's kind of where they make their profit. And then after that, they make less profit, but they're taking on additional risk. So there's some sweet spot where they want to sell coverage and they're incentivized and it's most profitable to sell coverage. And they're not necessarily going to push policyholders to take out even more coverage because it increases the risk on their end and is less profitable in terms of the margins for them. And another issue is that brokers or agents that sell policies aren't required to obtain more coverage or make sure that the policyholder has enough coverage to rebuild. They're sort of, they simply take orders from the policyholder. If you say, get me coverage, you're deferring to the broker / agent and the carrier to set the limits. If you say, hey, Mr. Broker or Miss Agent, I want to make sure you get me enough that if there's a fire and my house burns to the ground, it's enough to rebuild. I think that creates more of an obligation for them to affirmatively look for that. The policyholder specifically asked for something, but otherwise they're not a fiduciary to the policyholder. Look, unless there's some special
Shant,
relationship.
excuse me, isn't there a significant difference though between a broker and an agent? That an agent is the agent of the insurance carrier, I've always understood, and owes lesser duties to the policyholder than the broker, who is more specifically the agent of the policyholder and has higher responsibilities to a policyholder, and that it's important for a consumer to understand whether they're dealing with an agent or a broker when they're procuring insurance.
Very good point, Jeff. Yes, absolutely. And I was going to kind of touch on that when you, especially when you have specialty situations, a specialty spec home, or now we'll talk about other types of insurance coverage, a special type of business where you need a special type of policy and you go through a broker. The broker has, yes, there's a distinction. Broker and agent are used interchangeably, but in the world of insurance, yeah, there's distinctions. There's the agent and or captive agent of an insurance company who is a employee or agent of the insurance company that sells a policy. And there's a broker, someone acting as a broker for the policyholder or prospective policyholder. Yes, the broker, I think, has a higher obligation or a higher standard to meet when it comes to the policyholder. And an agent that's on the insurance company side, a captive agent, is not necessarily working for the policyholder. But again, it's always a fact-specific inquiry. When I do the longer version of this, I have a whole little section on broker negligence, and because it's always an issue. I often see, I didn't have enough coverage. Can we go after the broker? And the response is always, it depends, and not just in a lawyer automatic.
Yes,
it depends. It really does depend.
I find many times when I mediate coverage disputes, if the policyholder has been dealing with a broker, lurking not far behind the coverage dispute may well be a claim against the broker if, in fact, the coverage that the policyholder now is claiming they thought they should have had is actually not in place.
Yep. That's always, they're always worried about that. And that is another avenue. So even though I call this the 2 paths for recovery, there technically is a third path for when someone's underinsured. It's against the broker. That's absolutely right. 1 second here. Okay. The other path, the reason to go after other paths for recovery is because insurance doesn't cover certain categories of damages. And insurance is limited by the policy limits, right? The sheer dollar amount is limited, and the items that it covers is limited. So going after the third party that's responsible for the loss provides another avenue for recovery. In the context of the wildfires, this is often known as the utility lawsuit, the tortfeasor claim, the third party claim, the mass tort, or the mass action. And there's some confusion. People always say, oh, is there a class action, or is this going to be pursued through the class action? A class action, while technically they get filed in these wildfire or mass tort context or the mass disaster context, it's not the appropriate vehicle. It may capture some claims that are nominal and not individualized, but when folks are actually impacted by it, the best vehicle for pursuing the damage, well, I don't want to say the best vehicle, and I don't want to speak in absolutes, but class certification would be near impossible when you have individualized damages, while the liability issues are probably very common and appropriate for class certification. damages are going to be very individualized and very unique. So that's not going to be, I think, in my opinion, the best and viable vehicle. And that's what you see in practice too. So just a little overview of the litigation process when it comes to the tortfeasor claim. First, starting with, there's the filing of individual lawsuits. Something's happening on my end here. I'm going to step away for 1 second, Jeff, if that's okay.
Sure.
Okay, I think it was just my other monitor that turned off. So it starts with filing of individual lawsuits. These, again, it won't be there may be some class actions, but the bulk of these are going to be individual lawsuits that get filed. They get thrown into a coordinated proceeding, like a JCCP in front of the complex courts. There are two tracks. There's the liability track that gets pursued by a set of liability liaison counsel or leadership counsel. And then there's a damages workup that's done through standardized, agreed upon through a case management order, plaintiff fact sheet or damages questionnaires.
Shant, JCCP, for those who may not be familiar with the term.
I'm not sure what the abbreviation is. It's a it's through the Judicial Council. It allows for multiple sets of litigation to be overseen by one judge. It's a way to handle complex litigation, and it gets overseen by one judge. There's often the judge has the ability to issue or order a master complaint be developed. That way, if there's pleading challenges to that complaint, let's say there's 15,000 lawsuits filed, the judge won't have to deal with 15,000 demurs. They'll try to boil it down to various types of complaints, businesses, property damage complaints, and various categories, and only deal with a handful of pleading challenges. So, yeah, they get thrown into a coordinated proceeding, and they're litigated there. And then the damages workup is done sort of on a separate track on an individual basis. So for the folks that have filed individual lawsuits, they'll have to provide things like size of the home, various facts about it, a narrative about their experience, the type of loss they had. And it really depends on the situation. For example, in the Porter Ranch gas leak situation, it was a little bit more straightforward because it was sort of dependent on proximity from the leak to the size of the home and the number of occupants. With fires, it's a lot more individualized because you have people that have unique individual experiences. You have personal injury claims, you have loss of income claims, you have things like that. And there's a list of some of the categories of damages that are recoverable. Interesting fact, in these claims against the utility company, there's a 2017 case. This arose out of a 2007 fire in San Diego. And over there, the plaintiffs, the victims, were not at their house during the fire. They didn't see the fire from far away. And they were trying to bring a claim for emotional distress. And this went up to the Court of Appeal, I think in the 4th District. And the Court of Appeal held that even though they weren't there, even though they didn't witness it and think, like a NIED, negligent infliction of emotional distress type of claim where, they thought their family member was being hurt, just simply having to have their property be damaged and deal with the aftermath of that is enough to be able to recover emotional distress damages under the claims of trespass and nuisance, because nuisance has a unique annoyance and discomfort damages component that's available. So even for folks, look, it is going to be fact specific, obviously, how much damages you can get, but the entitlement to it is definitely there. If a policyholder or a homeowner loses their home, even if they're not there, even if they didn't have to flee, even if they didn't get personally hurt, they still have a viable claim that they can pursue against a tortfeasor for purely emotional distress. They don't need physical harm to themselves. They obviously need physical harm to the property. So that's definitely a component of it. I'm going to go over the claims process. I won't spend too much time on every point of it. But again, my goal here is for folks, if they end up helping a friend, a client, or someone they know, I want them to kind of know what they're doing. This is sort of obvious, but obviously safety first before going in to look at or document the damage to the property. Make sure it's safe. Make sure you're not breaking a law and trying to sneak in or something like that. And remember, even when these restrictions are lifted and you can access it, doesn't mean it's safe to access it. The byproduct of the fires, especially in the urban context, it's toxic. This isn't a campfire that burned for a long time or just wood that was burning. You're talking about home building products, plastics, rubber, lithium-ion batteries now that electric cars are so prevalent. All of this stuff just is absolutely toxic. And a hygienist will need to come out and clear it before you can go in there and spend much time in that environment. The first and obvious step is make a claim, open up a claim. The homeowner should open up a claim and ask for a full copy of the policy. Even if the homeowner is not sure whether they have coverage or not, make a claim. Even if there's multiple policies, make a claim under those policies. There's a clock that starts ticking when the event happens. It actually gets told once you make the claim and it's being investigated. But when the event happens, in fact, the policies will all say you have an obligation to tell us about the loss. So making the claim is an important thing. Once the claim is made, if it's a total loss, the homeowner should request an advance on funds that are available under the policy. In fact, if it's a total loss, California law allows for 30% of personal property, or requires for 30% of personal property benefits to be advanced without submitting any itemization, as long as you can first show that it was a total loss. You don't have to sit there and say, here's a list of my appliances and food and clothing that I lost. Ultimately, they can require you to do that. And it's probably a good idea to prepare that itemization anyway, but up front, the insurance companies are required to provide a 30% advance on the coverage C that we talked about, the personal property or contents coverage. And on the coverage D we talked about, if you remember, the additional living expense or loss of use, they're required to provide an advance of at least 4 months of living expenses. So same situation there. Again, in a total loss, they have to provide an advance. Now, the law doesn't dictate how much that monthly amount is, and there may be some negotiation or dispute as to that, but they have to at least, whatever they at a minimum consider to be the monthly amount you're entitled to, they have to advance 4 months of that. Again, if safe, go in and document the damages. If it's a total loss, I mean, just document the fact that it's a total loss. But then also, even without being able to go in, the homeowner should sit there and come up with an inventory. And I find if this is being done in hindsight, the best way to do it is come up with rooms and write down everything that was in each room, go back to it, think about it. You don't have to do it all in one shot. Just keep a list handy and whatever things pop into your mind. And note for preparedness, even for everyone here or folks you deal with, it is a good idea to go in and sort of film every room in a house, just so you have, A, you have proof, and B, you have at least a visual itemization of the things that were in that room. Because having to do that, fortunately, I've never had to personally do that, but I've had to walk people through doing that. It's tough. It's tough. It's emotionally tough, and it's just logistically tough. Imagine saying, close your eyes, now picture everything that was in your house. It's very hard to do.
Excuse me, I assume you live nice. Have you filmed every room in your house? What have you done personally?
I'm ashamed to say, as I sit here today, I haven't done that. Me and my wife always say we should do that. We should write an inventory, or we should kind of film it. And I haven't done that. And I know it's sort of, yeah, it's not great for me to say that without having done it myself. And it's easier said than done, right? And I just, I don't think I've sat there and done that. It's a good idea. Other preparedness things I could think of, tips for folks is, aside from creating some easy way to inventory what's in your house and filming it, is all those important documents. I know people want to save them in hard copy in a safe or something like that. Scan them. Everything's available electronically. You don't even have to scan them. You could probably download them from your insurance company, from your mortgage lender. save them in some cloud drive. Dropbox has a free option, and it's not going to exceed the size limit of that. Save them in some drive. That way, it may be a flash drive, but also the cloud drive, and then you can access it anytime. Copies of your driver's license, copies of insurance policy, the declarations page, a car title, various things like that. It's that I've done. I'm proud to say that I've done that. If somebody were to tell me, can I get a copy of your passport? I could email it over to you in 30 seconds because it's, sitting in a cloud folder somewhere. So the other thing to do, especially if the home is not a total loss, whether it has minor or major damage, people have concerns about looting and things like that. And a good idea is to secure the property. And oftentimes policies will have coverage for mitigation and boarding up the home so people can't get in, or putting up a fence so it's not an obvious. If somebody wants to get into the home, they're going to get into the home. But putting up a fence or boarding it up might deter that. I'm not saying the policy is going to cover 24/7 armed security around the house. I mean, I guess for some homes it might, but it will. They often will have coverage for securing the home. So that's another good idea. Or let's put aside the wildfire context. If there was a storm and the roof has been parts of the roof have been blown off, in order to prevent further water damage and further rain intrusion, you can have someone come out and put a temporary cover. And I'm not just saying they'll reimburse you for the $20 tarp from Home Depot, but you can have someone come out and kind of professionally, temporarily cover it, and then be able to recover that oftentimes from insurance. In the claim process, it's important, and I don't want to vilify insurance companies, but a lot goes on, and in their defense, in the insurance adjuster's defense, especially in the context of mass disasters, they are dealing with hundreds of claims. So things get lost, things fall through the cracks, things get lost in conversation, quite literally sometimes. So it's a good idea to keep a log of the communications with the insurance company. Keep your own log of, or the policyholder or the homeowner that's displaced should keep a log of what expenses they're incurring, what days they're at which location, because there's a lot of moving around in the early days of that. And oftentimes in dealing with this later on down the line, 6 months, a year down the line, I find that it's the hardest for policyholders, homeowners, to remember where they were in those early, most critical days, where they went through a lot. There was a lot of change. They incurred a lot of expenses because they didn't have a new routine yet. They haven't yet adapted to it. It's hard to remember. So it's good to have them keep a log of that. And also conversations. We have this saying that if it's not in the claim file, it didn't happen. Not because the insurance companies are out to screw people or something. It is sometimes an adversarial relationship, but simply because if an adjuster says, okay, great, send me that bill for that 1 week hotel stay and we'll pay it. I know it's $1,000, we'll pay it. And if they don't note it in the file, you don't send the follow-up confirming that. And then a week and a half later, you do send them that bill. They might look at it and go, we never authorized this. And they'll almost be justified in saying that, or it's an unnecessary fight or issue or dispute that could have been avoided if you just sent the follow-up saying, we just talked, you confirmed that you'd be paying the hotel bill, I'll send it over when I get a chance. And they might respond and say yes, and if they didn't say that, they'll chime in and say, I didn't say that, and you can deal with it then. But the erring on the side of caution, just note every conversation you have with them, and don't the policyholders shouldn't be I don't know, they shouldn't be aggressive about it. People should stand up for their rights. Policyholders do have rights, and they should stand up for them, and they should watch out for them. Insurance companies are sophisticated entities that are well equipped to defend themselves. But at the same time, I hate, because I do a lot of insurance bad faith, I hate when policyholders or even lawyers come to me and go, this is set up. We set it up for bad faith. We set it up. We look at this nasty letter we sent them. And it's like, that doesn't necessarily help you. People in the subsequent case can see through that. You put that in front of a jury, they're going to look at it and go, well, the insurance company was jerking them around, but they were kind of rude too. So be mindful of that. Obviously as lawyers, we never rush to sign documents, but specifically in the insurance context, there's something called a proof of loss, which is sort of the ultimate say of, here are what my damages are. And they'll often ask you to sign it, a sworn, sometimes notarized proof of loss that says, here are my damages. Be very careful about signing that. And it's okay to hold off on signing that until you have a full picture, whether you have your own contractor or professionals that are telling you what the value of, or the cost of rebuilding is, because that sort of locks the policyholder in when you sign a proof of loss. And the insurance company will, and ultimately has the right to rely on that and say, well, you signed under the penalty of perjury that the rebuild costs and your relocation costs tallied up to X. So I think policyholders should be very careful when they're signing that. The other reason to be careful about that is if there is a subsequent third-party lawsuit or a concurrent third-party lawsuit against a responsible party, oftentimes one issue that we run into is, let's say someone has $500,000 in coverage, and the cost of repairing their home is over $1 million. They might sign a proof of loss for $500,000 and say, well, they're going to pay me. The insurance company is going to pay me the $500,000. Let me just sign this and get it. Well, what happens in the subsequent bad faith, not the bad faith, the tortfeasor lawsuit against Southern California Edison, let's say, is when you go to settle those claims on an individual basis and you say, well, I got $500 from my insurance company, but rebuilding my house is going to cost, over $1 million. So you owe me the delta, utility company. The utility company will look at that and say, we have your claim file from the insurance company, and you bet they're going to have the claim file. We have your claim file. You signed a proof of loss that says the cost of rebuilding your house is $500,000, and you already got that from the insurance company. We don't owe you anything else. It's not a fatal problem, but it is an unnecessary fight that happens down the road. That's why it's important to, even if your damages or policyholders' damages well exceed the policy limits, it's a good idea, especially if there's a potential third party to go after for causing the loss. Like in the wildfire context, if there is a utility company, it is a good idea to properly document it and show that it's actually more than that. So that's something to consider in this context. The policyholder should be mindful of deadlines, because the insurance company, like I said in the beginning when we were talking about additional living expenses, even if you have a 24-month limit on the additional living expenses, that doesn't mean they have to pay the insured for 24 months. In fact, they have provisions that say, we will pay your additional living expenses for the shortest amount of time possible to reasonably move back into your house or reasonably repair the house. So, and that's always a problem in the wake of natural disasters, mass disasters, because price of everything is through the roof. Things take time to get done. Everything moves slower. So the best move for a homeowner there is to keep the insurance company in the loop as to what's happening. Okay, contractors coming out in a month. Permits still haven't been issued. Because if you don't keep them in the loop, they may look at it and say, well, this project could have been done in 4 months. We're on month 7 now. We're going to cut off your additional living expense benefits because we don't know what's happening. So it's always a good idea to keep them in the loop. Let's see. I want to go over some of the important statutes that apply. A lot of the folks here are lawyers, but also they're interesting. California has a pretty robust insurance law framework, both statutorily and in terms of case law. So I'll go over some of the most important ones. The Fair Claims Settlement Practices Regulations, the 2695. It sort of sets various standards for how insurers need to act in handling claims. For example, the one that I've highlighted here is they need to acknowledge a claim within 15 days. So no matter how busy they are, no matter what kind of a catastrophe it is, they have to say your claim is received and reach out and contact them at least within 15 days. And then they have to either accept the claim, meaning say that there is coverage, or deny the claim, or say that there is no coverage within 40 days after receiving that proof of loss that I explained. They can't just have it lingering out there. Now, in practice, this sort of gets dragged out because they say, well, we're accepting it for now, but we're reserving our right to deny portions of it, and things like that happen. But at least it creates some incentive for them to respond. And there's also slightly more, I'd say, ambitious or looser language in there about communicating clearly, not making misrepresentations as to coverage, not conditioning payment of agreed upon amounts on a release of the insurance company's obligations. There's language like that. And a lot of this is, it's pretty plain language and easy to read if you look up 2695. Another important one is the Unfair Practices Act 790.03, which literally lists out some things that, specific items that would lead to them acting in bad faith. Now, it's not a bright line test. It's not like if they do a particular item, automatic bad faith. You still need to prove that. But it's again, pretty robust set of standards for the insurance companies to comply with. You can't deny a claim without putting forth some sort of investigation. Again, in practice, what they'll say is, we looked into this, we spent a week thinking about it and we investigated, but at least they have that standard that a policyholder can hold them to if something happens down the road. Again, misrepresentations of policies, things like that, conditioning payment of benefits on a release. Next, 2071. This is a section we talked about, standard fire policy, but it also has provisions in there. It has specifics in there about how long after an agreed amount, when there's an agreed amount that's reached, how long after they have to pay. They have to pay within 30 days. And then there's a few sections that are specific to disasters, and I think this is a good place to sort of end this on, especially because there's 4 minutes left. There's restrictions as to non-renewals or cancellations. That's in 675.1B1. But there's also now a moratorium that was issued by the insurance commissioner on pending cancellations or non-renewals that were given notice of in, I believe, the 60 days prior to these recent wildfires that happened. Again, I think the bright line there is if the policy was set to cancel the day before these wildfires happened, then it wouldn't revive the policy. But for anything, let's say a policyholder had gotten notice that their policy is going to cancel on, I don't know, January 20th, there's now a moratorium on that. That policy cannot get canceled if the property is within the zip codes that were affected by this. And there's a whole list of the zip codes through the insurance commissioner's website, or the Department of Insurance's website. 675.1A3 is another good one. If there's a total loss, the carrier must offer renewal for at least 24 months after the loss. They need to renew it. Now, you might think, what good is that? It's a total loss. I'm probably not going to, the homeowner's not going to be able to rebuild for 2 years anyway. But still, other things might happen in the course of construction. There might be something else that happens. And there's other coverages that policies provide that aren't necessarily specific to that home, for contents and things like that. So, and it also helps the policyholder have a history of having continuous coverage. So there isn't some giant lapse in coverage when they're looking for a different carrier down the line. So that's helpful. And then 2062 says that when there's a state of emergency or there's a disaster, the insurance companies must offer to the properties affected by it, or in zip codes adjacent to the properties affected by the disaster, 60-day grace period for payment of premiums. And sometimes insurance companies might even offer longer grace period. So that's another thing to keep in mind there. Another thing that came to mind, a common question is, mortgages, things like that. Do homeowners have to keep paying it? It depends on the terms of the loan, but many loan servicers or banks or lenders have deferment or forbearance programs when the home is affected by this. So that's something else, like another question that I get asked that I tell people to check out. And I can't think of anything else. I know that this is kind of like, this is a lot to take on.
Yeah, you covered a lot of territory.
Yeah, I'm happy to talk shop with anyone. I love insurance. It's just a super fascinating area of the law. And then the tortfeasor claim, I find that it's a real effective way to help people actually recover. So, it's sort of like the best of both worlds. It's a privilege to make a living doing this and being able to somewhat help people. So
It's an excellent presentation, Shant. Thank you. Let me ask you one question. You, in a natural disaster situation or a mass tort situation, opioids, pharmaceuticals, things of that nature, a firm like yours may represent a great many plaintiffs with similar sorts of claims. And you have these coordinated proceedings, and you have to have certain efficiencies in how you handle the claims. At the same time, each person, each plaintiff you're representing is a different individual human being with different concerns and different personalities and all of that. How do you balance the need for efficiency with the need for every one of your clients to feel like they're getting some TLC along the way?
That's a very, very good question, Jeff, and something that I think about all the time, and I have very strong feelings about it. Again, this is not a plug for me or our firm or anything, but my personal philosophy, and I think our firm's personal philosophy on this is don't bite off more than you can chew. If sitting there and worrying that much about the efficiency of this process is like a top concern in your mind, that I think that means that you are commoditizing these individuals, these people that are clients that each deserve individual attention, because you're absolutely right. They each have individual claims. I personally, and my philosophy has been, I'd rather have a smaller volume of clients be able to provide them good service, just simply, yes, because it's the right thing to do, but also from a business perspective, because we can maximize and spend more time on each claim, accurately present their individual damages and maximize the value of their claim, instead of sort of treating them as buckets of, all right, let's settle this tranche of claims for this much and see how much we can get for them and just churn and burn and move efficiently. You know, some people's business model might be economies of scale and just do it. And it might be the profit margins might be great that way. I personally, I think it's a disservice. I don't want to criticize those business models because for all I know, they might be doing a great job. And even with the giant inventories of cases, recovering plenty for their clients. But I think the only way to give these cases, when people have lost their homes, their livelihoods, loved ones even, or been injured, is to give them personalized attention from actual lawyers and not just staff that looks at it as like a repeat kind of formulaic process. So that's my take on it. I think, yes, efficiency is important, but I'd rather focus on taking on less clients and maximizing the effort I put into them. You know, quality over quantity is my response and take to that on that issue.
Okay, thank you. On that note, our time is up. Excellent presentation, Shant Karnikian. Thank you. We hope that people are moved to contribute to a food bank in your honor. Please consider the St. Francis Center in downtown Los Angeles or a food bank in your own community. We appreciate it so much. Shant Karnikian, thank you. And with that, we are complete.
Thank you, Jeff. Thanks, everyone. I hope it was helpful.